What's happening right now in the U.S. economy is threatening to wipe out over 1 million jobs in a matter of months. And that's because one sector of the economy employs 12 million people. That's about 12 to 15% of all jobs. And based on what we're seeing in the data right now, it indicates that a lot of people could be on the unemployment line, and soon. Housing starts decreased 9.8% to an annualized rate of 1.62 million homes last month. The report illustrated subdued home construction activity as builders face a number of headwinds, all of which we've been warning about, including inventory levels of completed houses that now stand at the highest level since 2009. So if you think about this compared to the good side of the economy, when you see retail sales go down and you see inventories build, it backflows up into the manufacturing sector where they start to cut hours and lay people off. Now, if you look at this from the housing market perspective, you've got a lot of inventory, but what are we seeing in the survey data from home buyers? That their confidence level is at multi-decade lows. They don't want to buy, and for good reason, and that means, of course, that home builders are going to have to start cutting their construction back, and with that is going to go a lot of jobs. But it's not just single family, as we see multifamily starts also decline, now nearly 30% from the strongest pace since 2023. And a lot of this has to do with the fact that you continue to hear that there's a huge demand for multifamily. And so what happened is they built a ton of them. But right now, banks aren't eager to lend against them. And you're seeing a lot of these new developments, they're running out of cash. They need money. They're facing higher than expected interest rates. It's a big challenge. And as a result, what we're seeing is their number of starts are dropping as well. And again, as you see this happen and unfold, it means a lot of people are going to be out of work. Housing starts are running below the level of housing completions. This means that units under construction will continue to decline, and so too will the demand for labor. And really, that's all you need to know, because residential investment will be a drag on growth over the next few quarters. Well, the real risk is you have 12 million jobs tied to the housing sector. And if you get any sort of material slowdown, as you're about to see in the charts, what it means is we could see over 1 million people on the unemployment line. When you tack that what's going on in the other parts of the economy, it starts to become obvious. Let's take a look at this chart of new privately owned housing units started against the University of Michigan Consumer Sentiment Survey. That one's shown in red, and you can see the very strong relationship. When consumers are confident, well, they want to buy homes. When they're not, they don't. But here is the real risk. We go right to the latest report. We saw a big drop in consumer sentiment. What it's suggesting is there's going to be an equivalent drop in housing starts as demand goes away. But let's now overlay average weekly hours of production and non-supervisory employees in red, because it also has to do with wage growth. When people are making more money, they want to buy a nicer home, a bigger home, they want to move. But when pay growth slows, and the biggest indicator is hours worked, well, you see housing starts go down with it. But except there's only one time that didn't happen. That was going into the global financial crisis. You see the builders were very optimistic, building a ton of houses. At the same time, wage growth was not there. As a result, housing starts came plunging down, put us right into the global financial crisis. And based on what we're seeing in hours worked now, there's no indication that workers are going to be eager to snap up all of this inventory. And the other problem is, of course, is the labor market. If we see a downturn in housing demand, that means, again, people are going to be on the unemployment line, out of work. And now when we overlay continued unemployment claims, you can see how it can accelerate and get right out of control. As you see, new privately owned housing units started to decline going into the 91 recession. Continued claims rose. You see that happening in the dot-com bubble, but not to the same magnitude that we would see going in the global financial crisis, where housing starts just outright crash. Of course, that impacted the economy in a major way. We saw it briefly going into the pandemic, and we're seeing clear signs of it now. You can see the bottom of continued claims matches right in line with the peak in housing starts. If that continues to go down, just like with what we're seeing from the University of Michigan survey, what it indicates is over 1 million Americans could be out of work. And that's just if it happens here. You start looking around the world at Canada and Europe and other parts, what you can find out is housing demand, when it goes down, well, it means the economy is going with it. And prices have been drifting lower since peaking in 2022 as builders deploy incentives to try to clear excess inventory. And this is going to be a major problem for those in the resale market. We've seen this happen before where builders have margin, they have space to cut prices, but people that have bought in the past couple of years don't. They find themselves getting stuck. That's how we ended up in the last housing crisis, is on top of the fact we saw a lot of people taking out a ton of debt on their homes. They couldn't make the payments. Next thing you know, you couldn't compete with the builders, and everything started to fall apart. The NAHB is projecting a decline in one-family housing starts this year as builders slow down on projects to make progress on inventory, and the longer it takes to clear this inventory, and again, you think about this in the retail space as well, the longer it takes to get all of this excess inventory off the shelves and out of warehouses, the longer the economy is going to feel the pain. If it feels it for too long, then we're going to go right into a recession, and I think that's the big risk here. Based on what we're seeing in housing alone, we could see 1 million people out of work, but wait till you add it to what's going on in other parts of the economy. The situation looks even worse. The number of building permits issued in May fell to an annualized rate of 1.39 million, also a 5-year low. So again, we're looking back to the pandemic and seeing that the economy isn't expanding like everyone's thought. It's getting worse. Authorizations for construction of single-family homes also decreased to the slowest pace since April of 2023. So as we look forward to what builders are thinking, as permits go down, again, the demand for labor goes with it. Until this inventory gets worked through, we could face a very prolonged recession here, maybe even a financial crisis. Now, if all this inventory in housing and in the retail space can get worked through very quickly, then we'll see what looks like a soft landing. But that's not my base case. I want to know from you, what do you think we're facing here? A hard landing, just a regular recession, maybe a soft landing? Weigh in the comments below. Hit that like button. Love to hear from you. Because it's not just housing. Let's look at trade and transportation. We now see the movement of empties. That's empty containers as an indicator of demand. Because when you see empty containers leaving the port of LA and Long Beach, what it suggests is demand is rising, but right now there is no rush. Empty containers are sitting around. There's no demand for them to go back to Asia and other places. And this is, again, a major problem for the economy. The trickle-down impact of the reduction in ocean freight will filter through the pipes of trade, specifically trucks, rails, and warehouses. Competition for that coveted containers will eventually heat up, but the problem is right now, there's a negative impact of the container crunch is already being felt in labor. And for every 2 longshoremen members that have walked into the hiring hall recently, 1 went home without work. And what that means, of course, without work, that means their income goes down, their spending goes down. We've been talking about this from the discretionary side of the economy. It's very clear what's happening, not just with housing, but in trade and transportation. And again, it all leads to millions of Americans on the unemployment line in a matter of months. Let's take a look at this chart of imports of goods and services in blue against continued unemployment claims in red. And you can see as imports decelerate, the amount of jobs tied to it goes down, and you see continued claims go up. You can see this throughout every cycle, and we already know that due to the trade war that imports have come crashing down. Now, this chart has not been updated. It's only updated every quarter, suggesting that continued claims likely to head higher. And when they do, watch out, they're going to spiral out of control. And we got the data today because markets are closed tomorrow as applications for U.S. unemployment benefits ticked down last week. Initial claims decreased by 5,000 to 245,000 in the week ending June 14th, but still remaining at historically low level, but rather kind of high now for our current cycle. Continued claims of proxy for the number of people receiving benefits also fell slightly to 1.95 million. But keep in mind, if we do not see continued claims go down, initial claims will go higher. I think the risk is we get a breakout of over 2 million continued claims, and next thing you know, I think the whole thing spirals out of control. Because what I want you to understand is the longer people are on unemployment, well, their spending power goes down, affects, again, other people's jobs. They see their hours get cut, and then they see their job go. And there's other signs the economy is slowing down. It's not just in housing, challenging. It's not just in trade, it's in the energy sector. Here we see from the Department of Energy today, gasoline inventories up 209,000 barrels, distillates up 514,000 barrels, despite the fact that crude inventories fell, but that's obviously has something to do with what's going on in the Middle East. What you're seeing is consumers cutting back, just as we talked about the other day on airline travel. They're cutting back on driving. Everything here is telling us that U.S. consumers are getting into a dire place financially, and the less they spend, what you can see is it backfeeds all across the economy, slowly at first, and then it happens all at once. But for us, we're an import-led economy, but if you're on the export side like Japan, well, the slowdown isn't good news either. As Japan's export drop raises recession risk as U.S. tariffs bite. So here in the U.S., we see a decline in imports. Well, that tells us that we're facing recession. But again, you look around the world, Japan, China, other major export nations like South Korea, when they get hit, well, watch out. It's going to lead to mass unemployment all over the world. Japan's exports fell for the first time in 8 months as the U.S. tariff campaign weighed on global trade, raising the risk of a technical recession after the economy contracted at the start of the year. Export measures by value dropped 1.7% in May, but look at this. This is a big one. Imports declined 7.7%, with crude oil and coal seeing some of the sharpest falls. So what is that telling you? Demand internally is dropping. Demand for energy is going down. And in our economy, when you see demand for energy go down, it tells you the economy is going to go with it. Of course, this is also an issue. You look at energy prices rallying right now and what's going on in the Middle East. But if you look at the broad economy here in the U.S. and Japan and other parts of the world, it tells you energy demand is going down. There's maybe one rally if you're chasing, you don't want to stay in. The drop in exports of the larger trade deficit add to concerns that Japan's economy could shrink again in the second quarter. I think that's something we're going to see in a lot of economies, pushing it into a technical recession. Domestic consumption has remained weak as inflation continues to outpace wage hikes. Again, that's an issue not just in Japan. Here in the U.S. and all over the world, we've seen rising inflation, slowing pay growth. The problem is that leads to less demand. As demand goes down, the demand for labor goes right along with it. That's why I think in a matter of months now, we could be facing 1 million plus Americans on the unemployment line. And here we can see from Paula Cummings, the head of currency sales for U.S. Bancorp, when she talks to U.S. importers, demand for dollars is going away. People don't want to be paid in dollars, and that is a problem. So not only are we seeing global trade go down, we're seeing demand for the dollar goes down, and that means the dollar is going to get weaker. Potentially, we run the risk of inflation from a weaker dollar. So far, we haven't seen that. We may not see it because demand may erode fast enough, but for the Fed, who continues to deliberate about the direction of interest rate policy, one of the problems is they think inflation's coming. The reality is what we're seeing all around the world is demand is imploding. Instead, they ask for settlement in euros, renminbi, the peso, or the Canadian dollar, looking to limit their exposure to the greenback, which everybody right now thinks can only go lower. A lot of clients previously were reluctant because dollars were sacred in the eye of supplier. Now the vibe is just give us our currency. And again, we face a lot of problems here in the U.S. economy. We're facing a slowing housing market. We're facing slowing demand and imports and the weaker dollar on top of this. The question everyone's asking is, when will the Fed react? Well, will it be if the housing market declines? History says, yes, that is a factor, but it may take a while because when we look back through history, as housing inventories build up and housing starts go down, the Fed is eventually cutting. They were very late going into the global financial crisis. Looks like they're going to be late on this cycle as well. How about due to imports? Well, they tend to follow that as well. But here's another issue. It's always with a lag after it's too late. But ultimately, what will cause the Fed to react, and that is an unwind in the labor market. We know that when continued claims start to rise, and they continue to rise, the Fed banks, they cut rates. Everyone's wondering right now when? Well, at 1.95 million, the odds of the Fed cutting rates anytime soon isn't that high. But if we see a rise in continued claims, which I think is going to happen by the next Fed meeting and over the next several months, what you can face is a U.S. economy and a global economy that are headed down, and a Fed that's always behind the curve and aggressively cutting. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.